If the Treasury market is the backbone of global finance, the repo market is its bloodstream. It's the engine that enables hedge funds to leverage positions, dealers to make markets, and institutions to secure short-term financing. Understanding repo mechanics, and especially understanding what happens when collateral becomes scarce, is essential to interpreting stress in the financial system. A repo, or repurchase agreement, is essentially a secured loan. One party lends cash and the other pledges securities, often treasuries, as collateral. The interest rate on this transaction is the repo rate. In normal conditions, repo rates trade close to policy rates. But when demand for a particular treasury issue surges or supply evaporates, repo rates can fall sharply and even turn negative. This isn't a mistake, it's the market screaming that a specific piece of collateral is in extremely high demand. Collateral scarcity has multiple sources. Dealers may need a specific treasury to deliver into a futures contract. Hedge funds might be shorting a particular maturity. Foreign central banks may be absorbing supply for reserves. And during periods of quantitative tightening, the Federal Reserve withdraws collateral from the system, amplifying scarcity pressures. The shift to SOFR has also intensified the importance of repo dynamics. Because SOFR is calculated from actual repo transactions backed by treasuries, distortions in collateral markets can spill directly into the reference rate that underpins trillions of dollars in derivatives, loans, and securities. Another important factor is balance sheet capacity. Dealers have regulatory limits on how much collateral and how many repo transactions they can hold. When those limits tighten, especially around quarter end or year end, repo rates can experience abrupt spikes or collapse unrelated to fundamentals. During stress, these dynamics interact. For example, if hedge funds face margin calls, they may need to unwind leveraged treasury positions, flooding the market with collateral. But if dealers lack balance sheet capacity to absorb it, repo rates can destabilize quickly. This is exactly what happened in the September 2019 repo spike, when overnight rates surged to nearly 10% due to balance sheet constraints and unexpected treasury settlement flows. Repo is not a niche corner of fixed income, it's the operational core of modern financial markets. When repo markets behave strangely, it's often the earliest warning sign of system-wide stress. Understanding the mechanics, the collateral flow, and the regulatory constraints behind repo rates is essential for interpreting liquidity conditions in real time.